Hello, this is our company analysis for Gap in Company, and it's gonna be by Harshita Mistry, which is me, Cody, Parish, and Hannah Audley.
Gap operates by utilizing three major strategies for their business. This has allowed them to become such a large global empire that they are today, those strategies being franchising, innovation, and acquisitions. While there are other strategies that they utilize, these three are the biggest impacts on their business strategy as a whole. Franchising has allowed them to globally expand across the world in over 40 countries. Innovation through innovation they have developed a deep foothold on the online retail market, and as well as produced huge brands in the industry such as Old Navy, being the prime example. And through acquisitions, through acquiring other companies such as Banana Republic and Janie and Jack, that their portfolios only grown in strength, and that has allowed them to become such a major global empire that they are today.
So here's a brief summary of the SWOT analysis that we have done, starting off with the strengths, which included some factors such as increasing market share, forward integration, higher gross profit margins, and global recognition. Next is weaknesses, which included heavy reliance on third party vendors and mostly financing their assets through debt and having very high debt to equity ratios. Next is opportunities, which included growth in online shopping and expansion into global markets. Lastly, there's threats, which includes high industry saturation, volatile material cost, and low brand loyalty. So, to start off with the company's strengths, Gap has the greatest market share of 19.2% in the online baby and infant apparel industry. A greater market share means greater profits are generated, and this is compared to the family clothing industry in which Gap is present as well. Next is forward integration of value chain activities, which leads them to opening more brand stores domestically and globally, hence increase profit margins of its products. Forward integration can enhance competitiveness and contribute to a competitive advantage, like we mentioned, profit margins means greater pricing power. Therefore, as of Jan 2023, total stores in operation were about 3,352, which included 2,685 company owned stores and the rest 667 franchise stores. The total store size of them included about 31.8 million square feet across Europe, North America, and Asia. This means that Gap is growing globally. Next is the profit margin of Gap is about 38.8%, which means that Gap keeps about 38.8 cents in gross profit for every $1 in sales after covering its cost of goods sold. This is higher than 2023, which marked about 34.3% of gross profit. This could be due to improved cost management or better pricing power. Gap also has wide global presence, and established store network gives them a sustainable competitive advantage since it is rare and difficult to imitate. Lastly, brand recognition. This adds value to customer loyalty across different market segments and increases retention rates as well. So before we had the strengths, now we have the weaknesses of the company. Gap is heavily relying on third-party vendors and creating vulnerabilities in the supply chain. This places the company in a position where its buying power is likely to diminish over time. In year 2023, 30% of total sales came from factories in Vietnam, while about 17% of total sales came from factories in Indonesia. This can be considered a little risky because two of its largest vendors accounted for 8% and 6% of the total sales. Gap also has a heavy reliance on debt because roughly 30% of their assets are financed through debt. This suggests that Gap's interest expenses are likely to be high in their income statements. Next is debt to equity ratio, which they have is about 3.3, meaning that $3.30 in debt is for every $1 of equity. This is quite high and well above the industry threshold. A good debt to equity ratio is anything below 1.0, while a ratio of anything 2.0 or higher is usually considered risky. Um, this also indicates heavy reliance on borrowed money because such high ratio typically means that the company is not making enough money to cover its debt, which can be risky when profits are declining.
Following weaknesses in our SWOT analysis will bring us to opportunities. We have discovered many opportunities at Gap's disposal, and we believe these are just a few great examples to kind of show that. With the purchase of Janny and Jax in 2019, with Gap already having such a large lead in the children's clothing market area, this only helped them. This allowed Gap to widen the gap. Since they're already in such a strong area within that market, this can only help them. This can allow them to get a larger clientele, more market share, as well as produce many more opportunities in that area that they would maybe not have at their disposal without access to the backlog of production from Janny and Jax. This, in tandem with their meteoric rise in the online fashion industry, has given Gap a very good position to grow and gain more customers in online fashion retail in general. They have also been working to improve their globalization, utilizing franchising as a major key point in that. This has allowed them to expand in many emerging markets, such as Latin America and Southeast Asia. And this is once again due to their utilization of franchising. Following opportunities brings us to our final point from the SWOT analysis, and that will be threats. There are many different threats that can negatively affect Gap, but one of the largest ones is the sheer amount of competition within the fashion market. The fast fashion retail market is incredibly oversaturated, and Gap has to work incredibly hard not to fall behind. This is shown by the difference in revenues between multiple different companies. Gap made roughly $15 billion in revenue in 2023. And while that does and is an incredibly large amount of money in revenue for a single company to make, when compared to other similar size competitors such as TJ Maxx and Macy's, it's quite low compared to theirs, with TJ Maxx roughly making $54 billion in the same year, and Macy's roughly making $24 billion in that year. This puts them behind TJ Maxx, Macy's, and Ross, which puts them roughly in fourth place in their market. Another potential threat that could be negatively affecting Gap is the recent push towards localizing production of their products in the United States. With the recent trend of wanting to move production over to the domestic United States, this can cause their production costs to go up. As well, another factor of this is the constant fluctuating prices of raw materials. With the prices of raw materials going up and down, this can cause inconsistency in their cost of production, which can potentially cause many financial issues for them in the future.
So, some concerns, like stated in the weaknesses of our SWOT, they're heavily dependent on debt. So, with 1/3 of their assets being financed, there's a potential for an economic downturn, which could lead the company to lose a large portion of their assets. So, the oversaturation in the retail clothing market presents a challenge to produce a competitive advantage due to the large numbers of competitors in the market. Gap is also heavily dependent on third-party manufacturers, which opens them to many vulnerabilities. So a recommendation would be a strategic shift, gradually moving them from the oversaturated apparel market and focusing on doubling down on children's and maternity wear, which could create a more focused brand identity. So this can be done using a focused approach utilizing differentiation, market penetration, product innovation, and acquisitions. Differentiation by separating them from the generic clothing market, they would be able to focus on producing high-quality children's clothes. Innovation, which is similar to the differentiation, they could launch new product lines, children's clothes, and different material wear. Horizontal mergers and acquisitions would be useful since they already have history in acquisitions. They could look to continue this by collecting more business from their portfolios, such as like the Children's Place, Oshkosh, and Ingrid Isbell. Could also use a moonshot approach. The number of employees working for Gap is higher compared to peers in the group. Therefore, Gap can potentially get involved in backward integration, meaning they can initiate their own manufacturing, which provides more quality control measures. They can also choose and source higher quality materials. So more cost savings and a profitable strategy. Gap can potentially eliminate markups from external suppliers, optimize resource production through economies of scale, and then directly control over costs. Leads to higher profit margins. And backwards integration offers Gap greater control over supply chain, allows product innovation and creativity, while immensely decreasing its dependencies on outsourcing its products. Larger workforces can provide necessary manpower and the expertise to successfully operate these manufacturing units.